moving on now to the auto sector. Domestic auto industry has seen muted growth in the second half of the year. And the question is, will Trump's tariff war impact autos, especially companies with exposure to the European region also? To discuss all this and more, Sunil Bohra, Group CFO at Uno Minda, is now with us on the show. Mr. Bohra, that's the first question, right? How do tariffs impact you? If you do get any sort of reciprocal tariffs, if you could lay out how you're assessing the impact for you, considering your export exposure, and also European markets were downbeat for you. You've highlighted that in the past. What are we seeing right now in the Jan to March quarter? Have things improved, and what can you guide for FY26?
Yeah, so thanks. In terms of your first question of tariff, so if you see our total revenues, we are largely a domestic company. Almost 89% of our revenues are domestic driven, and roughly around 18% is what we get from our global revenues, which includes operations in ASEAN, in Europe, and we have a small plant in Mexico. So overall, if you see of the overall pie, the exports from India is roughly around 4%, 3 to 4% of our total revenue. So as of now, we don't see any significant impact based on whatever discussions we are having with our customers. The exports, whatever we are doing from India for some switches or seats, we are not seeing any material impact as of now, but definitely things are evolving as we speak on a daily basis. So we are keeping a close watch on that. So as of now, we don't foresee any significant impact in the short term. In terms of your second question, which is Europe, in terms of our revenues, definitely things have been sort of stable to, I would say, marginally positive, because the revenues what we have generated from Europe in January and current February, whatever the trends are, they looks to be stabilizing in terms of volumes, and even our revenue is marginally better versus if I compare with the December revenue. So things are stable, but I would still be very little cautious, and we are not very too much optimistic in the short term in Europe, while things are stabilizing and looking a little positive.
Okay, let's focus on the bigger part of your business then, Mr. Bohra. Europe is still to come back to life, but you have 89% of your revenues from the India operations. Has there been any kind of slowdown? Is demand, ordering activity as good as what you expected in Q4? And what does this mean for the next couple of years? That's FY25, FY26 as well, on the base that you deliver on FY25.
So we have no reasons to complain in terms of volumes. Things are definitely, we are in a business, and business will have ups and downs, but overall things are positive. In fact, if you see full year two-wheeler revenues, two-wheeler volumes are roughly around 9% higher. PV is roughly around 5%. In fact, last month is almost like closer to double digits in terms of volumes. And in terms of the medium term to long term, you spoke about 2 years and beyond. So we are very, very optimistic. And as you know, that we are currently having 12 projects or 12 plants under construction. And we have been building some of the lands for our future growth. So we are very, very optimistic in terms of the industry growth. We are roughly 4.5, 5 million PV cars this year. Hopefully, we should grow 2x in next 7-10 years. We are way, way below some of the global benchmarks in terms of vehicle ownership. So we are very optimistic in terms of 2 to 5 year kind of a scenario. Yes, there are some ups and downs, as I said, because of being in business. And as we always say, we continue to maintain our guidance in terms of our performance. So while we don't comment on volumes, whatever industry grows, our goal is clear that we grow at least 1.5 times of industry growth. So if industry in next 5, 7, 10 years grows 2x, we have to see how do we grow 3x in terms of our revenue. So that's where we are, and we are quite optimistic, and we continue to invest in our expansion plans.
Okay, all right. Could you tell us about the EV focus of the business? You know, how much does it contribute? Because that's been growing at a very, very fast clip. And that's definitely going to help you in terms of a kit value as well. So how do you see it panning out from here on?
No, absolutely. So we have been front runners in terms of EV capturing the business for specifically two-wheeler and three-wheeler sector. And if you see the two-wheeler sector, we are almost 2x of the industry penetration in terms of revenue. So industry growth is somewhere around, industry penetration for EV in two-wheelers is somewhere around 6-7%. Whereas of our two-wheeler, the revenue pie is roughly around 13%. So we are almost running at 2x of the industry growth. And that's clearly demonstrating our ability to capture the EV market share. In terms of our kit value, as you rightly mentioned, while the ICE kit value is roughly around 10,000 rupees, our EV kit value is almost 35,000 rupees per vehicle. And that market is still in a developing stage in terms of what gets to outsource, what get in-house, etc. So we've been working very, very aggressively in that space. In fact, moving to the PV space, as you would have noticed, we have been front runner again in localizing, working to localizing some of the EV components for pass cars. And we have recently converted our TLA to a joint venture with Innovance. And currently we're in the phase of preparing our detailed project reports. And hopefully we should be coming out with a detailed project investment plan, etc. And once we do that, then it will take roughly around 2 years to localize. And as we know that the volumes for four-wheeler are also low. So we are trying to time with the industry penetration as the volumes increase. Our capex also is expected to align with that, and hopefully we should get advantage of the better volumes.
So 2 years before the localization efforts come into fruition. So how should we investors look at your margins? You've guided for 11% margins for FY25. Do you think for FY26 it should be similar to 11%? When can margin expansion truly begin for you? How are you thinking about margins and raw materials cost?
So you have to see in two aspects. First, from the margins of RM cost you mentioned. So raw material for us is largely passed through, whether it's upcycle or down cycle. It's all passed through to our customers. We don't tend to benefit or we don't tend to lose on the commodity prices, right? But in terms of your question was on margins in terms of 11% plus minus. So next year we are currently working to see how do we maintain this margin. Specifically, we know that we have 12 projects under construction. As these projects come on stream, you have all the costs coming in. So you have to absorb those costs, whereas the revenue takes maybe 1 or 2 years, 3 years to stabilize and to deliver the target returns. So despite that, we are working to see how do we make sure that we absorb all those costs and still maintain our margin guidance of 11% plus minus 50 basis points.
Mr. Bohra, thank you very much for joining in.